Gold isn't rallying, it's repricing the credibility of the deficit, and the paper market is trying to pass it off as just another emotional trade. This move is not a vibe, it's math. And the most important signal isn't even the headline spot price you're staring at. It's the quiet pressure that shows up around delivery, spreads, and positioning before the mainstream has the language to admit what's changing. By the end of this, you'll have a clean, mechanical roadmap for what could pull gold toward a $600-700 zone. What level matters in the next 1 to 2 weeks? What would break the thesis and the single tell that usually flashes before the next leg hits? Start with where we actually are, because if you don't anchor the tape, you start hallucinating. In January so far, gold didn't behave like a sleepy commodity. It behaved like a stress asset with a bid that refuses to die. We've seen gold climb from the low to mid 4,000s at the start of the month toward the edge of $5,000 per ounce by late January, with the kind of stair-step pattern you normally associate with regime shifts, not just a trade. And that's the first friction point. The story people want to tell you is, oh, it's just a wobble in stocks, or it's just a Fed cut bet, or it's just geopolitics. Clean, simple, familiar. The problem is, the tape doesn't look like a one-variable story. It looks like layered demand meeting a market structure that's less forgiving than people think. And that's where the real pressure starts. Here's the hidden detail that changes how you see the whole thing. In tight moments, gold doesn't scream through the spot price first. It whispers through urgency, through the cost of getting metal now versus later, through the behavior of the futures curve, through leasing and availability chatter, through the way dips get absorbed even when the macro narrative should be leaning the other way. Because paper can create supply instantly. Physical can't. And when more players start preferring now over later, the market has to pay up for immediacy. Not because of conspiracy, because of incentives. And when immediacy gets expensive, that's not emotion, that's constraint. Now zoom out and talk deficits, but in a way that actually maps to price discovery. Most people explain deficits like a bedtime story. More debt equals inflation equals gold goes up. That's not wrong, but it's incomplete, and it makes you late. Deficits matter because they force choices, and those choices don't stay theoretical. The government has to fund itself continuously. That means constant issuance, constant rolling, constant auctions that are effectively a referendum on confidence. In a world where deficits remain structurally large, you eventually hit a point where someone has to become the marginal buyer at a price they don't love. That someone could be private markets demanding higher yields. It could be domestic institutions that get nudged into absorbing supply. It could be policy leaning toward lower real rates through cuts, through financial repression, through inflation tolerance, through liquidity injections when something cracks. Different paths, same destination. The bond market stops being a calm, risk-free benchmark and starts acting like a crowded trade with a funding problem. And when the bond market starts to feel like a funding problem, gold starts to feel like the opposite of a promise. But that's not the part that matters. The part that matters is how fast this can flip once the market internalizes the constraint. Think of deficit funding like gravity. In normal times, gravity is there, but you don't notice it because the plane is stable. In stress times, gravity becomes the whole conversation because every maneuver costs more. As debt levels climb and refinancing needs stay heavy, the system becomes more sensitive to rates, more sensitive to volatility, and more dependent on confidence staying smooth. The moment confidence gets bumpy, the cost of carrying everything goes up, and the entire financial complex starts looking for hedges that don't require someone else's ability to pay. That's gold's home turf. And you can see why big institutions suddenly feel comfortable putting higher numbers on the table. You've probably seen the headlines. Major banks raising targets, talking about $5,400 by end 2026. Some voices floating $6,000 by spring 2026. Even saying $7,000 isn't unthinkable in certain scenarios. Here's how you should interpret that. The forecast itself is not the alpha. The shift in permission is the alpha. When the street starts publishing numbers that used to sound insane, it's often because their models are being forced to respect a new regime, persistent official sector demand, renewed private flows, and the macro reality that deficits don't unwind neatly without pain. That's not bullish sentiment. That's institutions updating their risk frameworks because if they don't, they get blindsided. And that's the next detail that flips the whole setup. Let's stack proof, because a single argument is how you get fooled. Proof point 1, the price action and its character. Not up or down, but how it moves. The climb has looked more like bid persistence than like a speculative blow-off. Dips don't linger. Breakouts don't immediately mean revert. That tells you demand is not just tactical traders hitting a headline. It suggests longer horizon buying that AS willing to absorb volatility. Proof point 2, futures market participation. We've seen heavy volume and rising open interest in gold futures recently, which is a sign the market isn't just closing positions into strength. It's building exposure. When open interest grows while price pushes, That can indicate new money entering, rather than merely short covering finishing the move. Not always, but it's a real tell when paired with the rest. Proof point 3, central banks. This is the bid nobody wants to argue with because it doesn't show up like a day trader. Central bank buying has been elevated for years, and recent data has shown net purchases staying substantial, including periods where central banks collectively bought over 1,000 tons in a year. That matters because it changes the floor under the market. It turns gold from a purely speculative, risk-on-risk-off instrument into a policy asset. When official reserves are being diversified, the demand is not price-sensitive in the same way. A hedge fund can puke in a margin call. A central bank can buy quietly through drawdowns because they're playing a different game. And that means the market doesn't clear the same way it used to. But that's still not the whole puzzle. Proof point 4, ETFs and private flows. Central banks can light the match. ETFs can supply the oxygen. When Western investment flows return to gold, ETFs in size, hundreds of tons over a year in some stretches, it creates a mechanical feedback loop because those products have to buy metal as they grow. And once flows begin, they don't care about your opinion of fair value on any given day. They care about allocation decisions, risk parity decisions, macro hedging decisions, and performance chasing. That is how you get persistent bids that keep showing up even when the commentariat insists the rally is overextended. And that's where the market gets dangerous for shorts. Proof point 5, the fiscal data itself. The deficit is not a rumor. Official budget projections have put annual U.S. deficits in the multiple trillions range in the years ahead under baseline assumptions, and recent fiscal year tracking has shown large deficits early in the year as well. Here's what matters about that. It's not a single year of overspending. It's the stickiness. Entitlements, interest costs, and political incentives make sharp fiscal pivots rare. Markets can forgive a one-off. Markets struggle with a structural pattern, especially when that pattern intersects with a world that's less willing to fund you at any price. And that intersects directly with currency credibility, which is gold's ultimate macro driver. Now let's talk about the mechanism people miss, paper versus physical, but without the cartoon villain voice. Futures markets exist to create liquidity and manage risk. They do a great job until the market starts demanding the underlying in a way that doesn't match the paper assumptions. Physical gold has a supply chain: mining, refining, transport, vaulting, assays, bar sizes, delivery standards. None of that scales instantly. That means the paper market can print exposure on demand, but the physical market can't print deliverable bars. So if the world shifts even a little toward preferring metal that's deliverable and allocated, the stress shows up in subtle places first: tighter spreads in certain venues, stronger premiums in certain channels, increased competition for specific bar formats, more sensitivity around delivery windows. And when that stress rises, futures pricing can start to reflect urgency. Not every day, not in a way that makes a perfect headline, but enough that professionals notice. And the pros position before you get the story on television. So what does that force participants to do? It forces refiners, dealers, and large holders to be more careful with inventory. It forces shorts and futures to respect the calendar. It forces bullion banks and market makers to manage balance sheet constraints, especially when volatility rises and margin requirements tighten. It forces participants to pay up for now when now is scarce, and it forces price discovery upward when the marginal seller disappears. That's the clean, boring, non-conspiratorial way to describe what feels like a dramatic rally. Incentives plus constraints. Now, layer in the accelerant: options and dealer hedging. Options don't create the long-term thesis. Deficits and credibility do that. Options create the short-term speed. Here's the simple version. When a lot of call options stack up at certain strikes and price starts moving toward them, dealers who sold those calls often hedge by buying the underlying. As price rises, the hedge requirement can increase, especially in certain gamma conditions, so the dealer buying can feed the move. It's reflexive. It doesn't care whether the news deserves it. It cares about risk management. That's how a market can feel like it's being pulled by a magnet. And that's why, when certain levels break, the math changes. Now we're ready to talk about the $6,700 concept without sounding like we're selling a lottery ticket. A number like $6,700 is not a promise. It's a scenario output. It's what you get when you assume a few realistic conditions. Deficits remain large enough to keep issuance pressure heavy. Policymakers are reluctant to let real rates stay punishingly high for long because the system's sensitivity grows. Central banks continue diversifying reserves, and private flows follow as the narrative shifts from gold is dead money to gold is the only money with no counterparty. Under those assumptions, gold doesn't just drift higher. It reprices to a new equilibrium that reflects higher fiscal risk premia and higher currency risk premia. Think of it this way. Gold is a price of trust. When trust is abundant, gold is boring. When trust is questioned, gold becomes a scoreboard. A move from the 4,000s toward the 6,000s is not speculation mania in that framing. It's the market assigning a higher cost to fiscal drift and monetary flexibility. And here's the kicker, that repricing can happen faster than you think, because markets don't revalue linearly. They revalue in steps, long complacent periods, then one break, then everyone can unsee it. But we also need to talk counterpoints, because credibility is everything with a skeptical audience. There are real ways this can fail, or at least stall hard. Counterpoint 1, a sustained real rate shock higher. If inflation expectations fall while nominal yields stay high, real yields rise, and that can pressure gold, especially if the dollar strengthens in a global squeeze. Counterpoint 2, a genuine fiscal pivot that convinces markets the issuance path will improve. Not a speech, not a committee. Actual policy with teeth. Counterpoint 3, a liquidity event. In a true market-wide margin call, people sell what they can, not what they want. Gold can get hit in those episodes because it's liquid and it's there. Counterpoint 4, positioning. If the market gets too one-sided, even a bullish regime can punish you with violent drawdowns designed to shake out weak hands. And that's the part retail always underestimates. So here's your psychology shield, because this is where most people lose money even when they're directionally right. Gold will whip around. It can drop hard on a day when the thesis is actually getting stronger. It can spike on a headline and then fade as liquidity returns. It can punish you with a nasty retrace right after you finally buy, because you couldn't take the FOMO anymore. The market's job is to transfer conviction from the impatient to the patient. If you don't build rules ahead of time, volatility will build them for you in the worst possible moment. Your enemy is not the dip. Your enemy is the story you tell yourself during the dip. Here's a clean way to separate trend from noise. Trend is what shows up across multiple layers at the same time. Persistent demand, supportive flows, structural macro tailwinds, and market structure that refuses to mean revert. Noise is the day-to-day headlines, the single data print, the one scary candle. Noise will be used against you. You'll get a day where gold drops and the headlines scream rally over, right as the underlying demand is quietly absorbing supply. You'll get a day where gold spikes and everyone screams breakout, right as dealers are unloading hedges and you're buying the top of a gamma wave. If you don't understand the mechanics, you become the liquidity. Now, why now, specifically? This moment matters because of the calendar and liquidity. Month-end and quarter-end dynamics change behavior. Funds rebalance. Risk managers tighten. Liquidity pockets thin out, especially around major policy windows and major expiry cycles. At a backdrop where fiscal conversations are live, issuance is heavy, and the market is increasingly sensitive to rate expectations, and you get a setup where a relatively small catalyst can produce a disproportionate move. That's how you get gaps. That's how you get overnight repricing. And that's why the next 1 to 2 weeks matter more than people think. So what comes next? 2 scenarios. Keep it simple and tradable even if you're not trading. Scenario 1 is the controlled pullback and retest. Gold pauses, pulls back into a support zone, shakes out late buyers, and then reasserts the trend as flows reappear. In that scenario, you want to watch whether pullbacks are shallow and quickly bought, whether futures open interest stays healthy rather than collapsing, and whether the dollar and real yields can actually sustain a pressure campaign. If gold dips and snaps back quickly, that tells you the bid is structural. If gold dips and churns for weeks with no rebound, that tells you the market needs time to digest and you need patience. Scenario 2 is the continuation squeeze. That's the one where gold doesn't give you the clean entry you want. It grinds higher, then breaks a well-watched level, then liquidity thins, and the market starts gapping in a way that forces risk managers to chase. In that scenario, you're watching for signs of reflexivity. Price pushing through round numbers, option strikes acting like magnets, and an absence of real selling into strength. The danger in this scenario is psychological. People either chase too late or they freeze because it feels too high. That's why you need a plan before the candle prints. Let's talk levels without pretending we're prophets. The market has been orbiting the psychological $5,000 area. That zone matters because it's visible. It's where media attention spikes. It's where options positioning often clusters. It's where managers who avoided the move feel pressure to justify staying out. Above that zone, the next leg can accelerate simply because the permission barrier breaks. Below that zone, the key question is whether the market treats any dip as a buying opportunity or whether it starts to accept lower prices. If we see a sharp rejection and sustained trade back below the prior breakout region, that would weaken the near-term squeeze narrative. It wouldn't kill the long-term deficit-driven thesis, but it would change the timing and the path. Now, if you want a single metric to watch that ties the whole story together, it's this. Watch for stress signals that suggest immediacy is being bid, not just price. Watch the behavior around delivery windows. Watch whether strong price is accompanied by healthy participation instead of fading interest. Watch whether the curve and related spreads behave like a market that's comfortable or like a market that's paying up for certainty. When those stress signals appear, the paper price often follows. When they disappear, the market is often setting up a shakeout. That one detail is what flips the whole setup, and we haven't even addressed the uncomfortable truth most people done to want to say out loud. Deficits done to have to cause inflation tomorrow for gold to reprice today. Gold can front-run the policy response, because markets don't wait for the fire, they price the smoke. If policymakers face a choice between sustained high real rates that risk breaking credit and banking plumbing versus a path of cuts liquidity support and tolerating inflation to keep the system functioning, markets start making bets before the official statements. Gold is one of the cleanest expressions of that bet, not because it's magical, because it's simple. No earnings, no cash flows, no default risk, just scarcity and trust. So if you're skeptical, and you should be, ask yourself what would need to be true for gold to not only hold these levels but push materially higher over the next year. You'd need deficits to shrink meaningfully without a growth collapse. You'd need the bond market to absorb issuance smoothly without policy help. You'd need global reserve managers to stop diversifying and rotate back toward concentrated exposure to a single currency system. You'd need private flows to stay away even as price trends and narratives shift. That's a lot of would needs. Not impossible, but not the base case many models were built for. Now let's connect it back to the $6,700 idea in a way that respects risk. A $6,700 zone is not next Tuesday. It's a level that becomes plausible when the market decides the old range is obsolete. The path can be messy. Rip, crash, consolidate, rip again. But the logic is coherent if deficits and the policy response remain the dominant driver, and if the hidden detail, urgency for real metal and hedges without counterparty, keeps strengthening under the surface. And if this one visible level breaks and holds, the narrative shifts from gold is overbought to gold is the benchmark for fiscal reality. And once a benchmark shifts, portfolios shift. Quietly at first, then loudly, then all at once. Here's the final warning, because this is where people get played. Volatility will be used against you. If gold keeps climbing, the messaging will be, it's too late, don't touch it. If gold pulls back, the messaging will be, see, it was a bubble. Both narratives are designed to keep you reactive. Your job is to stay mechanical. Decide what time horizon you're operating on. Decide what would confirm the thesis for you. Decide what would invalidate it. And accept, up front, that even a correct thesis can be punished on the path. That's not a flaw. That's the market doing its job. So here's your near-term checklist for the next 1 to 2 weeks, in plain language. First, watch how gold behaves around the big round number zone near $5,000. Does it accept above it, or does it reject and churn? Second, watch the dollar and real yields. Can they mount a sustained push that actually pressures gold, or do they wobble while gold holds? Third, watch participation. Does futures interest and activity stay constructive, or does the move look like it's running out of fuel? Fourth, watch for signs of urgency and stress in the plumbing. If now stays expensive, the story is tighter than the headlines. Fifth, watch the calendar. Thin liquidity and positioning windows can turn small catalysts into big moves in either direction. If you're here for the identity of it, if you be the kind of investor who wants the mechanism, not the meme, then stay in that lane. You don't need to predict every candle. You need to understand what forces participants into action, what changes when the market crosses a line it can't unsee, and what would have to happen for the whole thesis to unwind. Because the next phase of this won't be explained honestly in a clean headline. It'll be explained after the fact, once portfolios have already moved. And if you want one last pull forward to keep in your pocket, it's this. The price will try to convince you it's random, but the structure will tell you if it's real. When deficits collide with policy limits, the market doesn't politely adjust. It snaps. Not because someone decided it should, but because the math stops working at the old price. And when the math stops working, gold doesn't ask permission.